Good morning. The market is flying blind into the Fed's next decision. Here's the plan for November 12, 2025.
That's the number of official October CPI and jobs reports we're getting. 0. The White House has confirmed that because of the shutdown, this critical data will likely never be released. So this is the core uncertainty for today's session. The Fed is being forced to make a huge decision with an incomplete picture. And right now, the market is just waiting for one key signal, that government reopening vote, which is expected around 7 p.m. Eastern. This data blackout is creating some serious crosscurrents. Let's break down the conflicting signals we're seeing right now. The tape is showing a major divergence. On one hand, you have price action. The S&P 500 is hovering near all-time highs. But underneath the surface, the internals look weak. Subprime auto delinquencies just hit their highest level since 1994, and that signals real consumer stress. You've also got rising daily volatility fighting declining weekly vol, and sentiment is at extreme bullish levels, which, as you know, is often a contrarian red flag. It's a real tug-of-war between the bulls and bears. Despite this complete lack of official data, the derivatives market is making a very high conviction bet. It's pricing in a 65.4% probability of a 25 basis point rate cut on December 10th. What this tells us is that traders believe the underlying economy is weak enough to force the Fed's hand, even without the official numbers to back it up. So where's the money actually moving? Well, this macro uncertainty is creating some very clear winners and losers at the sector level. U.S.-China tensions are escalating, and it's creating a direct divergence trade. Reports say China plans to block access to critical rare earth magnets. That's a major headwind for U.S. defense contractors. But the flip side of that is a powerful tailwind for non-Chinese producers, like the ones you'll find in the REMX ETF, as the rest of the world is forced to reshore and diversify their supply chains. The AI sector is another key battleground, pitting a powerful growth story against some historically stretched valuations. On one side, you have AMD projecting 35% annual growth, talking about insatiable demand. But on the other, names like Palantir and Vertiv are priced for absolute perfection. Institutions are hedging with large put trades, and you have guys like Michael Burry flagging accounting concerns at Oracle and Met. These divergences get even more stark when you pull up the charts. The S&P 500 is showing multiple signs of exhaustion. While price is pushing highs, momentum, the force behind the move, is failing to confirm. We're seeing negative divergence on both the daily and weekly charts. At the same time, sellers are showing renewed strength. This is a classic warning sign that this rally is losing steam and is definitely vulnerable.
And this just brilliantly illustrates the rotation that's happening. As the broad index weakens, the automobile sector is showing significant technical strength. Names like XPeng, GM, and Rivian are breaking out of long consolidations on high volume. This is a textbook setup for the beginning of a new leadership cycle. The strategy here is to watch for entries on pullbacks to key moving averages, like the 18 period.
Okay, before we get to the game plan, here is the required disclaimer.
And a quick note, if this is helpful, you can subscribe and turn on notifications for our new weekly market update playlist, so you don't miss any of the weekly recaps. So, with a market this divided, how do you position yourself for today's session?
We're preparing for 3 potential outcomes, and they are all driven by that shutdown vote and the data uncertainty.
Our base case assumes this uncertainty is going to persist. That means choppy, range-bound action in the indices. The posture here stays defensive. It favors stock selection in strong sectors like autos over just making broad market bets until we get some clarity. The bull case really hinges on a clean resolution to the shutdown tonight. A reopening removes a major headwind, it validates the market's bullish positioning, and it would likely greenlight the Fed's expected cut in December. That could easily trigger a risk-on rally through key resistance levels. And the bear case? It's a Fed policy error. The combination of no data and visible consumer stress could force a hawkish pause. That would spook a market that's positioned for a cut, likely breaking key support, with the most overvalued tech names leading the way down. So here are 3 potential strategies reflecting these themes. For that auto breakout, a call debit spread offers a defined risk way to play for upside. To hedge that AI overvaluation, a long-dated put debit spread bets on a decline while limiting your capital at risk. And for the China divergence, long calls on REMX could provide leveraged exposure. Remember, options involve substantial risk. Your capital is at risk, and losses can exceed your premium. Manage your size and define your exits. If this breakdown helps your preparation, the best way to support this work is to like and subscribe for the next morning brief. That leaves a final question to frame your trading day. In a market that is flying blind, is the bigger risk the official data we can't see, or the clear divergences in the data we can?
This is not financial advice. Markets carry significant risk, so trade your own plan, manage your downside, and verify all information. Trade safe.